Hello, dear student. I have explained you earlier what is a capital structure, and we know that capital structure is basically the combination of the debt and equity. But the ratio of debt and equity is very difficult to be decided by the management because there are several factors such as ownership, liquidity, and the compulsory payment and the image of the company. There are the different other factors which influence decision. And based on the capital structure, there are several other decisions which the company has to take. So all these decisions I will discuss with you in this lecture. So we know that the basic objective of the firm is to maximize the value of firm. It means to maximize the shareholders' wealth. Means the shares value of the each shareholder has to be increased by the company. And how that will happen? When there will be a proper debt and equity ratio. And once it is there, then only you can deal with it. How this shareholders' wealth can be increased, the value can be increased by investing in those projects that yield a higher return than the minimum acceptable hurdle rate. What is the hurdle rate here? Hurdle rate is a discounted rate or discounting value of the any project. So whatever the minimum rate of return which is required, that is what is known as acceptable rate or hurdle rate. Now this hurdle rate should not be higher, because if in case of higher hurdle rate, risky project will become more risky, in case the owner's fund and the borrowed fund both will give you higher cost of capital. So it means the returns on these projects should be measured based on such cash flows which are generated, and the timings of these cash flows should be calculated properly. Now all these cash flows should consider both positive and negative side of each project, because none of the project will be self-sufficient in itself. Now you have to choose a financial mix which will minimize the hurdle rate and matches the asset being financed, because whatever the investment you're making into the assets, long-term assets, plant and machinery, and investment in case of patent, copyright, etc., it should be such whereby you should be able to increase the value of the firm. And if there is not enough investment, then the earn the hurdle rate which is acceptable to the stockholders, means shareholders. If it is not, then your company cannot function. Then the form of the returns and dividends and stocks will buy back its will depends on the shareholders characteristics, because shareholders attitude towards the firm will determine what decision they take in the board of directors meeting and also in the annual general meeting, because it is their expectations which need to be fulfilled. If they are not being fulfilled, then what will happen? The people will drive out, the people will sell out their shares, and then the market value of the shares will go down. It means the ultimate objective of the company, that maximization of the shareholders' wealth, will not be fulfilled. So that is why shareholders' characteristics will play a major role in defining the concept where the maximizing the value of the firm is most prominent factor. Now, what are the choices you have to make in financing? When you want to finance your business operation, there are only two ways by which you can take the fund for your firm. First is a debt, another is equity. Now you have to choose between debt and equity, that how or what percentage you have to take from debt and what percent from the equity. Because one way the debt cost can be adjusted against the profit, it means the income tax due will can be reduced, or income tax can be paid out of the reduced, so that the total cost and debt can be reduced. Whereas equity does not have the compulsory payment. So where the debt has the compulsory payment, so cost of equity will increase in that case. So the essence of debt is basically that firm has to make a promise that they will be making a fixed payment as installment and interest on those loans. Then the equity, you can get the cash flows, but these equity holders will get payment only after the money is paid to the shareholders, sorry, debenture holders and the debt holders. After paying to the debt holder, if any money is left over, then that only will be paid to the equity shareholders. So when you take fund from equity, again you have to make a choice. For a very small business, the owners cannot issue the equities. They have to run their business from their own savings or loan from their family and friends. But in case some larger business houses, even the venture capital can be available. But in case of publicly traded firm, it is the equity stock, a common stock, which is the best form of financing. Then the debt can be taken by the different firms, but again, the firms, large firms can issue the bonds, but small firms, sole trader, can only take loans from their family and friends. Then in case of private businesses, they generally use bank loan as debt. But for public traded firms, they can issue the bonds and debentures also. So the debt and equity ratio, or the sources of debt and equity, will depend upon the nature and the types of firm, that how much fund they require and from where they can take it actually. Now the basic question which arises in case of deciding the capital structure, the financial mix for any company, that is deciding to raise financing for a business, is there optimum mix of debt and equity? Now what is the debt and equity ideal mix? That ideal mix has to be decided by the firm, but it is very difficult process, because in case of recession is there, debt is the best form of the financing. But in case of a booming economy, growing economy, equity is the best option. So that is why the firm, this question of the financing mix and the ideal mix, optimal mix, will change over a period of time. And then the question is, if the debt and equity mix is right, then what is the trade-off by which you find out this optimal mix? Whether you have conducted such research or not. If not, then obviously the question is why not? Ultimately, this question of the trade-off has to be decided by you only, because that will decide minimum hurdle rate at which the return has to be earned from the business. Now, how will you measure the financing mix, which I was talking with you just now? The best and the most simple way of measuring the debt and equity is at the proportion of debt and equity financing, and which is also known as debt to capital ratio. Now debt to capital ratio, debt divided by the capital, it means debt plus equity. So debt will have all the interest bearing on the liabilities, and short term as well as the long term. Now the equity can be defined based on the accounting terms. What is the value of the shares in the market? So that you can find out with D1 plus D1 oblique P0 plus G. And then the debt ratio can be different based on the market value of the shares, the market value of the bonds also. So always in the changing scenario, the changing financial mix shall be adopted by the company. It means the management must show a flexible approach towards the capital structure of the firm. So the next thing comes, what are the different costs and benefits of the debt? The first benefit of the debt is that it has got the cheapest cost, and then the tax benefits are also available. So tax, whatever the tax has to be due, that can be deducted out of the interest. So for example, 40% tax rate is there. It means the debt cost can automatically reduced by 40%. Then it also adds discipline to the management, because in case of compulsory payment of the loans, you need to have a situation whereby every company has to see that the minimum interest rate can be paid. Otherwise, what will happen? That the firm may not be able to earn the sufficient money, and hence they cannot grow themselves. And then comes cost of debt. Cost of debt basically is that interest rate which the firm has to pay, and that is the annual interest rate payment, but it also includes the cost of the uh, flotation cost. So the combined effect of these two will be the cost of debt. Then comes bankruptcy cost. Sometimes the firm may have to find it very difficult to pay its interest and amount due at the time of maturity. So in that case, that's what is a level which is known as bankruptcy cost. Then the agency cost. Sometimes there can be the clash of interest between the shareholders and the debenture and bondholders. So the clash of this interest is known as agency cost. Then the loss of the future flexibility. In case of debt, there is a flexibility because after the due date, you can pay off the bonds or the debentures, but the same thing is not available in case of equity. Now, again I will discuss with you what are the tax benefits which are available in case of bonds. When you borrow some money, you are allowed to deduct the payment of interest out of the as an expenditure from income. It means net interest or net tax payable on the bonds will be reduced by that much amount. So when you take a loan in form of the debt, or you have any payment due on the loan, then whatever the rupee tax benefit always be there for you. So tax benefit for each year, so tax rate into the interest payment. So the first condition what it comes, where other things if remain equals, the higher the marginal tax rate of the business, the more debt it will have in the capital structure. So if the tax rate is high, obviously the companies will like to have more of the debt because that much tax exemption they will get. Then what will have the impact on this? The first impact will be that it will reduce the cost of the debt. And then when you are comparing the debt ratios of real estate corporations which pay the corporate tax rate and the real estate investment trust which are not taxed but are required to pay 95% of their earnings as dividend, which of these groups would expect to have the higher debt ratio? So real estate companies, real estate investment trust, and others has to be told with the information only. So debt, at the second point I said, the debt adds to the discipline of the management. Yes, there's no doubt in that. When you manage firms with no debt, you can generate high incomes and the cash flows each year, and you tend to become complacent. So that will happen a situation that where you need that you need not to pay a compulsory amount, so you will not be able to work properly, or you will not be that much sincere. But when your firm has borrowed the money, you need to pay the interest, then your attitude towards the complacency will not be there, and you have to earn the money because you know that it is you who has to pay the fund. And if you will not be able to pay, then it will cause the bankruptcy cost. So cost of not doing enough in order to pay the interest on time will result in a bankruptcy, and in that case that manager can lose the job also. So that is why that manager will always try to earn that much profit, by which it can not only pay the interest, but it can also earn the profits which it can give it to the shareholders of company. So that ultimately adds to the discipline. You assume a situation where you buy into this argument that the debt adds discipline to the management. You have to do the certain things. Conservatively financed company where is only very little debt is there, it means the privately owned companies, their business is run smoothly and they do not take any attention and they do not bother much about the incomes, so they do not diversify themselves. What conservatively financed public traded companies, stock held by millions of investors, and none of whom had a large percentage of the firm, obviously the firm will not be ready to take more loan, and they may be complacent, the managers, and in that case the return for the firm will reduce. Then conservative finance public traded companies with an activist and primary institution holding, they will have to earn more, otherwise there will be a problem. Then this also generates the bankruptcy cost. Why the bankruptcy cost is there? One is the direct cost. You have to enter into the legal and other debts cost, and then indirect cost, where the cost arising because the people perceives that you are to be in financial trouble. Today, if the kingfisher has to purchase or has to take a loan, it has to pay higher cost because the public perceiving that they are in higher trouble, and that is why you need to pay a higher amount. Now this higher amount is known as bankruptcy. The probability of the bankruptcy will depend upon how certain you are about the certain futures. If your future cash flows are at stake, or you are not sure whether you will be able to pay the future cash flows, then there will be a problem. And if you borrow more, you increase the probability of bankruptcy more because expected bankruptcy cost will increase. The second proposition that says that if other things being equal, the greater the indirect bankruptcy cost and the probability of the bankruptcy in the operating cash flow of the firm, less the debt of the firm can afford to use. It means if the probability of the fact that the firm is having higher debt and the debt cost is very high, in that case, firm will not be able to take more of the loan. Again, the example of the Kingfisher Airlines and the Air India, where the higher loan is there and the bankruptcy cost is also very high, where the public or the institutional investor feels that it is the firm which may not be able to give you the higher amount of return. So the firm cannot take more loan. Although it may wanting to take a loan, but if it takes, then again the compulsory payment will increase, and whereby it will be difficult for the company to carry on its business operations. Now, the debt and the bankruptcy cost, these are two terms which are closely related. If you have to decide on the magnitude of the bankruptcy cost, highest to the lowest, then it will be the grocery store. It means the multiple store companies like Walmart, etc., or Suviksha, or the Big Bazaar company of the Kishore Bayani group. These will have a highest number of bankruptcy cost because the capital which is employed will highest. However, the payment will not be very high. Then any aeroplane manufacturer companies or high technology company will be the least of the bankruptcy cost, because the people will generally give loan to a high technology company because they know that sooner or later, if this company would have come up with any technology which is will be high demand of the public, then obviously all the previous dues will be cleared. So the bankruptcy cost will be lowest. So technology firm can run its business operation by the bank or the debt operations only. Now the next comes agency cost. It arises when you hire someone else to do something for you, and it arises because your interest as a principal and interest of agent does not tally. It means there are the managers in the firm who are not in agreement with the intentions of the management of the company. In that case, what will happen? That firm may not be able to achieve its objective, and in that case, when you lend money to the vision business, you are allowing the stockholder to use that money in the course of running that business. And in that case, what happens? You, when you are a lender, are interested in getting your money back, but the stockholders are interested in maximizing your wealth. So obviously, what will happen? That the firm may not be able to earn enough amount, and there will be the agency cost, which will in turn make it almost impossible for the firm to function smoothly. Now, in some cases, what happens that this interest clash will lead to investor in rising project, riskier project that you would want them to. It means management would like to take the more interest where stockholders will want the riskier project should be undertaken so the return should be higher. But whereas managers you would like to keep into less riskier so that firm should function. Then third proposition is that if other things being equal, the greater the agency problem associated with lagging firm, less debt the firm can afford. Obviously, a firm is not true on the fact or not an agreement fact that whether the firm should borrow or firm should have equity, obviously there will be a problem. Hence, the firm cannot improve itself. Now, this debt and agency cost are also closely linked because a large pharmaceutical company will always have a highest amount of agency cost because the managers would always like to have invest in the case of research and development activities so that the firm can earn more revenues, whereas large regulated electric utility company like Power Grid Corporation will like that they should have more and more profit, and whereby they can maximize the shareholders value. So there will be the clash between debt and agency cost of the company, and based on agency cost, debt of the firm can be taken. Now, when a firm borrows up to its capacity and loses the flexibility of financing future project with debt, so always the firm has to take loan below its maximum capacity, is meant 40 to 50% of the total capital. Now I am discussing with you the fourth proposition, which says that if other things remain equal, the more uncertain firm is about its future financing requirement and project, the less debt of the firm will use. So if the firm is not sure about the future of itself, it will not be able to take the loan, and obviously it will take equity, because in that case it will feel that in whatsoever the result is coming, I will be able to do it. Now, how this decision has to be decided, I am giving you a certain test for that. First, consider for your firm whether potential tax benefit of borrowings are there or not. If they are present, then take the loan without any doubt. The benefit of using debt as a disciplinary measurement, I told to you that debt will bring the discipline in the company, because the management will always feel that in case we have the debt, we need to earn at least minimum revenue so that interest rate can be paid. The potential of the expected bankruptcy cost. The bankruptcy cost is rising. You should not take more loan. Then the potentials for agency cost shall be reduced. And the firm should always have the financial flexibility. If it does not have the financial flexibility, it cannot improve. So would you expect your firm to have a high debt ratio or low debt ratio? It will depend upon the functions of the firm. It will depend on the nature of the fund. It will depend upon the management's objective of the firm. And then ultimately it is the economic condition will decide whether I want to have my company as a low debt or high debt company. And does the company's current debt ratio meet your expectations? Again, I have to see the market environment and other factors, and if they are within the limit, I will be satisfied. Otherwise, I have to change it. Now, I am giving you a hypothetical scenario where I will discuss certain things. For example, you assume a situation when there is no taxes, although in real life there is no situation where you will not have a tax. So, if there is no tax, obviously there will not be any difference between the debt and equity. So, debt will not be cheaper in that case, so you will go for the equity only. And if there is no separation between stockholders and managers, there is no agency cost. So, whatever the decision you want to take, whether the debt or equity, you can take. And then there is no default risk. Obviously, any person would like to give you the loan. Then there is no separation between stockholders and the bondholders. You have to establish a relationship between these two. And generally it does not happen. Then the firms know their future financing need. If firm know what are the future financing needs, then you should take these things into account. The most important of all these aspects is the Modigliani and Miller approach, which says that in an environment where there are no taxes, default risk, agency cost or capital structure is irrelevant. Because once nothing is there, there is no fundamental, neither the tax, nor the risk, nor the agency cost. So you can go either for equity, 100% equity, 100% debt. It will not make any change to you. So the value of firm will be independent of the debt ratio. So whatever the firm you want, you can have that nature of the firm. Now, when approach is there, it means there is no leverages, because once the capital structure is relevant, so you cannot have the leverage also relevant. A firm's value will be determined by its project cash flow, and the cost of capital of the firm will not change with the leverages. As a firm increases leverages, the cost of equity, which will increase just enough to offset any gains in the leverages, so there will not be any leverages will be possible. Then, what do firms look at in the financing? Is there a financial hierarchy? If the firm is able to achieve its objective, does it have any slope of a flow of financing? Why it is necessary? The first thing, there are many persons who will argue that the firms follow a financial hierarchy, with retained earnings being the most preferred choice for financing, followed by the debt, then the equity, the least preferred choice. Why? Because the retained earnings are there in the firm without any obligation, without any problem, you can use that fund. Then the debt, because if you increase the equity, obviously the shareholders' value will decrease, because now the lesser money will be available per shareholders. So that is why they will go for the debt, which will give them the tax compensation or relaxation also. Why this financial hierarchy has to be there? First, managers will value the flexibility, and in case external financing reduces the flexibility more than the internal financing, because in internal financing you are basically involve your own fund, but in case of borrowed fund, it is others fund which you are using, and you are giving only the opportunity cost. So managers are value control, and issuing new equity weakens the control, and new debt creates the bond convenient also. So that is why it is necessary that there should be a proper mixing of the debt and equity. So if someone asks me to summarize this lecture, I can say, my dear, that capital structure is a mix of the debt and equity. However, the decision regarding the quantum of this risk is not easy. It will depend upon the several factors, such as risk-free rate of return, interest rate, time period, nature of the management, agency cost, and bankruptcy cost. However, if there is no enough investment that earn the hurdle rate or return to cash to stocks, the decision will depend upon the fact that managers value flexibility. It means what the management thought. Then external financing will reduce the flexibility more than internal financing, because managers will always value the control. So issuing new equity will weaken the control, and new debt creates bond convenience. So that is why firm will always like to have bonds as compared to the equity. Thank you, my dear. Thanks. I hope you have understood how capital structure should be determined by different companies and what are the factors which are responsible for it. Thank you, my dear. Thank